And with that, I yield to the gentleman from Texas.
Thank you, Mr. Chairman. And again, thank you for having this hearing. You know, one of the things I think we need to point out is that prior to securitization, as Mr. Calabria said, is there were people that bought mortgages that didn't go through Fannie. In fact, I originated and actually was in the banking business for a while, and we sold those loans to other financial institutions, the insurance companies. But securitization does provide a certain amount of liquidity opportunity for investors to hold those mortgages and some other ability to manage interest rate risk. And so certainly we don't want to do away with securitization. Back to what I think Mr. Pollack has said and maybe Mr. Redonzo has said and the other panelists is probably where the big mistake is here is we've had the government setting the risk premium. And the government doesn't have a very good record on setting the risk premium. All you have to do is look at our flood insurance program and realize we haven't been charging the appropriate amount of money or monetary for the risk that the government is taking. And so, so there's really not much space for private market right now because the risk premium is so low that getting these loans sanitized by Freddie and Fannie makes more sense than doing it outside. So isn't it a way to make some space for private securitization or for private investment? I don't want to get, is to lower these conforming loan limits and at the same time increase the risk premium that Freddie and Fannie are charging for buying those loans and securitizing them. At some point in time, the private market is going to say, you know, I'm not willing to give up 50, 75, 100 basis points, whatever that is. I'd rather have that yield than go through that if I knew that those loans were being underwritten in a fashion that gave me some sense that these are good quality residential loans. Good underwritten residential loans is a good investment. Is there consensus that that's got to be some of the initial steps if you're going to bring the private market in, is you've got to take away the competitive advantage of Freddie and Fannie? Calabria?
I would say absolutely, and as I mentioned in my testimony, I do think you need to institute a fee to try to recoup some of the money we've put in, and obviously the one benefit of that is you recoup some taxpayer money. The other benefit is you reduce the competitive advantage that Freddie and Fannie have. I would also emphasize, and I know Alex has made this point, we really do need to change the incentives facing the banking industry. If you hold a Fannie Mae security, it's only a 20% risk rating, where if you hold a whole loan, it's 50%. So to some extent, the existence of Freddie and Fannie has reduced the capital behind mortgages by about 60% of the system. So I don't think a public policy objective should be, how do we get less capital into the system behind mortgages? So making that a little more equal in treating Freddie and Fannie securities as if they are any other corporate securities, I think would shift the incentives of banks.
Mr. Pollack.
I think you make a very good point, Congressman. We might ask, looking back historically, why did a private securitization market for middle-class prime loans not develop? It's a natural market. It doesn't need a government guarantee, and the reason it didn't was because nobody could compete with subsidized providers, namely Fannie and Freddie, who enjoyed tens of billions of dollars of taxpayer subsidy, effectively. And so one way I've thought about the question of how could you make that move with guarantee fees is to consider that now the Fannie and Freddie historically had very much lower capital than other people. Now they have no capital at all, literally zero, and their own capital is very negative. So one might do a calculation and say, if Fannie and Freddie had to have the same capital as everybody else for a risk, and they had to have a reasonable return on that risk, what would their price have to be? You remember with the Federal Reserve some years ago, the Congress put in what they called the private sector adjustment factor to take away the Fed's, which Fed is a kind of a GSE, take away the Fed's pricing advantage. You might think about that same kind of calculation along your lines
kind of risk-based
with
pricing,
them.
basically,
Yeah.
is what you're saying.
Yeah.
And I think I agree totally, is that whatever we do over at Freddie and Fannie, we can't make FHA the new subprime lender. And so we're going to have to go over there and determine what the lending limits and the credit underwriting standards are going to be over there as well. Otherwise, we just move that market. Mr.
And
Brenda,
the one thing I would add to what my colleagues have said is I think that the approach that you mentioned with a few other steps addresses the concerns on the other side of the aisle, that this is not jumping into privatization. You're not ending Fannie Mae and Freddie Mac tomorrow. You're incrementally dropping the conforming loan levels, and you're raising your G fees to let private capital begin to step in slowly over time. It's not this leap of faith and just trusting that capital is going to be there from the private sector. It's we are going to take these short-term steps, and along the way, the private sector can adjust, can look at the new rules of the game, and we can begin to back the government out slowly.
thank you. Thank you, Mr. Chairman.
Thank you. And my